As of January 2019, this regular podcast is available on our Andy Yeh Alpha fintech network platform. Global trade transforms from labor cost arbitrage to high-skill knowledge work. In fact, multinational manufacturers have been trying to create global supply chains that source goods wherever costs and wages are lowest in exchange for product sales wherever aggregate consumer demand is greatest. This macro trend drives global economic growth, helps alleviate poverty outside the OECD trade bloc, and contributes to the recent rise of China. This trend also helps fuel a political backlash in America. A recent McKinsey study finds that the share of cross-border tradable goods has fallen sharply from 28% to 22% in the past decade. This reversal of fortune partly reflects the political backlash against trade in America. The same trend also shows a key increase in consumer demand in China and several other Asian economies. These countries now buy more of their own goods and also experience substantive improvements in domestic supply chains. Tradable goods decrease as a share of global economic output, whereas services soar to account for almost a quarter of productivity gains. International trade transforms from labor cost arbitrage to high-skill knowledge work in R&D innovation and intellectual property protection. This transformation takes place in specialty industries such as information technology, pharma biotech, e-commerce, and social media. British Prime Minister Theresa May faces her landslide defeat in the parliamentary vote 432 to 202 against her Brexit deal. British Parliament rejects the May deal for Brexit, so this outcome becomes the greatest defeat for a government initiative in British democratic history. Theresa May subsequently survives the parliamentary vote of no confidence that emerges from a tactical motion by the opposition Labour Party. There are at least three options for Brexit. The first option is the recent May deal with the European Union, the second option is an economically catastrophic no-deal Brexit, and the third option is the likely eventual cancellation of Brexit due to a second referendum. British Parliament now rejects the first option off the table. Some British politicians suggest that the European Union may make some further concessions to the Brits, but the European Union reps are unlikely to fold in the current game of Brexit negotiations. The stock market response suggests that a second referendum on Brexit seems more likely than an economically detrimental no deal. Stock market analysts tend to view the May defeat as a smooth transition toward Brexit delay. As stock market investors perceive a no-deal Brexit to diminish in likelihood, the British pound gains momentum in recent times. In Britain, the main parties oppose one another and so demonstrate substantial division among themselves, whereas, U.S. congressional split runs broadly along partisan lines between Democrats and Republicans. Many May-led Conservative Party members want Britain to stay in the European Union, some want to consider another deal, and some want to leave the European Union without a compromise deal. Labour Party whip leader Jeremy Corbyn prefers a second referendum on Brexit, and most party members cannot speak with one voice on the wider socio-economic implications of the British divorce from the bloc. There can be a second referendum on Brexit only if British lawmakers face reality and risk reprisals from constituents who favour and expect Brexit. Meanwhile, there is no absolute majority for any plausible option, and thus Britain now skids toward the default outcome of no-deal Brexit at the end of March 2019. The least worst-case scenario would be a major delay of a few months. This delay would give stock market investors, firms, and financial intermediaries more time to tackle the next transition. From a global perspective, the best-case scenario might involve a second referendum on Brexit for Brits to remain in the European Union. Netflix raises its prices by 13% to 18% for U.S. subscribers. The immediate stock market price soars 6.5% as a result of this upward price adjustment. The baseline subscription now costs $9, up from $8 per month. The most popular HD standard plan costs $13, up from $11, and the 4K premium plan costs $16, up from $14. These price increases take effect for new subscribers and will apply to the current Netflix subscribers in the next quarter. There are good economic reasons for these retail price increases. First, the U.S. aggregate demand for Netflix video streams is inelastic in the sense that price increases can compensate for any potential loss of current subscribers. Due to the low price elasticity of demand for Netflix original content, the same video streams are likely to boost sales and profits with minimal negative impact on the current scale of the Netflix subscriber network. Second, Netflix requires greater cash inflows to strengthen its financial resilience. Meanwhile, Netflix borrows funds to close the cash flow gap between regular cash outlays and revenue intakes. The recent price increases can therefore help reverse this financial situation. Historical experiences further support the business case for higher prices in light of the Netflix cash burnout dilemma. Overall, the recent Netflix price increases make much economic sense. Higher public debt levels, global interest rate hikes, and subpar Chinese economic growth rates are the major risks to the world economy from 2019 to 2020. American public debt now hovers around $15 trillion with another $6 trillion intergovernmental debt positions. This debt dilemma poses a core conceptual challenge to the Trump administration that may need to carry out counter-cyclical fiscal policies to contain the next economic recession. With $1.5 trillion infrastructure expenditures and $1 trillion tax cuts, the Trump administration faces a hefty $800 billion fiscal deficit. As the Treasury funds the fiscal deficit with incessant government bond issuance, the Federal Reserve has to raise seigniorage taxes in the form of higher money supply growth. In turn, this money supply growth causes higher prices as inflation surges beyond the 2% to 2.5% target threshold. The current U.S. Phillips curve remains flat and thus reflects low inflation and low unemployment. In accordance with the dual mandate of price stability and maximum employment, the Federal Reserve should continue the gradual interest rate hike at a slower pace. The U.S. financial history suggests that unforeseen asset market surprises can cause key capital investment retrenchment as the government fails to implement counter-cyclical fiscal policies in time. Moreover, Chinese real GDP economic growth can decline from 6.5% to 7% to 5.5% to 6%. As the Chinese Xi administration continues to decentralize the consumer-led economy, this transition translates into lower demand for international goods and services. With the primary focus on exports and real estate investments, China may cause inadvertent contractionary spillovers into several East Asian countries and some Western open economies. U.S. households and firms may face higher costs of tradable goods and services as the Chinese economy experiences subpar economic growth. However, the latter may be a minor concern in light of the likely Sino-U.S. trade war resolution. On balance, the U.S. Federal Reserve needs to better align medium-term interest rate adjustments with fiscal expectations between the White House and Treasury. Optimal interest rate decisions may need to react to productivity surprises, inflation expectations, economic output gaps, and asset price gyrations. To the extent that macroeconomic fluctuations manifest in credit conditions and corporate profits, the central bank has to consider conservative interest rate increases. From Australia, Britain, and Canada to Germany and Japan, international monetary policies may start to follow the current U.S. interest rate hike. The new global interest rate cycle can be especially pertinent for European and East Asian small open economies. U.S. government shuts down again because House Democrats refuse to spend $5 billion on the border wall that would give President Trump victory on his best-known policy. No other OECD democracy experiences abrupt government shutdowns. Should the current U.S. government shutdown be about policy differences, House Democrats would be able to achieve a compromise deal with the Trump administration. However, this congressional standoff is about presidential authority. President Trump must win this battle, otherwise, he would allow House Democrats to constrain his presidential power. A major concern is that President Trump may use his national emergency power to build the southern steel border wall. In this worst-case scenario, the eventual degradation of good government may continue. In reality, the current U.S. government shutdown happens not because America is in turmoil, the country is not at war, the economy operates near full employment, and even Fed Chair Jerome Powell praises the robust economic outlook with low inflation and high productivity growth. The current U.S. government shutdown happens because President Trump has to fulfill one of the most controversial campaign promises that his fervent followers favor. When the U.S. government reopens, Congress and the Trump administration can revisit the comprehensive issues of both border security and immigration reform without having to inflict financial pain on public employees in the specific form of furlough or work without pay. Sino-American trade talks make positive progress over 3 consecutive days as S&P 500 and non-U.S. stock market indices post 3-day win streaks. Asian and European stock markets reap sharp gains primarily due to cautious optimism over the results of complete trade negotiations between China and America. In this light, stock market analysts view these trade talks as serious and productive because these talks extend to the third day with some concrete trade war resolution. The 3-day trade negotiations between mid-level Sino-US senior reps end on a positive note and also help clear the way for subsequent higher-level trade talks. All of these joint effects aim to avert a major escalation of the Sino-US trade war in early March 2019. The Xi administration pledges to buy more U.S. goods and further seeks to improve the best practices on Chinese intellectual property protection. These trade talks can help reduce the Sino-American trade deficit by a substantial dollar amount. The Trump administration emphasizes the clear intention to ensure Chinese compliance with continual verification and effective enforcement. Meanwhile, the Trump administration continues to restrict Chinese investments in critical technology transfers from U.S. tech titans such as Apple, Amazon, Google, Intel, Microsoft, Nvidia, and Qualcomm etc. Americans continue to keep their financial New Year resolutions. First, Americans should save more money. Everyone needs a budget to ensure that regular paychecks outweigh cash expenses. Second, Americans need extra money to pay off credit card debt. More than 44 million Americans take on second gigs to help eliminate credit card debt, about $16,000 per capita. Third, Americans should spend less. Millennials need to reduce disproportionate expenditures on utility and leisure. Fourth, U.S. workers below 50 years old can save $18,500 per year toward their 401k retirement accounts. Socking away $300 per month for 30 years can accumulate $285,000 with a conservative 6% average annual return. Fifth, Americans need to build their own emergency funds. About 57% of U.S. adults have less than $1,000 in their bank accounts, and 39% have no emergency funds at all. Americans should aim to achieve these New Year resolutions for better financial freedom. Fed Chair Jerome Powell suggests that FOMC members need to be patient to wait and watch before they hike the interest rate again. The U.S. central bank continues to cash in public debt near maturity to attain a substantially smaller balance sheet. Stock market analysts foresee the next interest rate hike around mid-2019 as Federal Reserve governors raise their dovish tones. With majority control, House Democrats passed 2 bills to reopen the U.S. government without funding the Trump border wall. President Trump makes a surprise White House appearance to reiterate his intention to keep up the fight for the signature campaign promise of a southern border wall against Mexico. House Speaker Nancy Pelosi states that both President Trump and Republican Senate should take yes for an answer to approve the two bills without border wall finance. If President Trump and Republican Senate pass these bills, federal agencies would receive public finance to end the partial government shutdown. Several House Republicans break with the Trump administration and vote in favor of reopening the U.S. government without any border wall tax. It is unlikely for President Trump and Republican Senate to accept this outcome without any form of border wall finance. However, the Trump administration may need to realign stock market investor and taxpayer expectations with less than $5 billion public finance for the southern border wall. In the ultimate best-case scenario, both parties need to compromise on this public finance issue. Otherwise, President Trump, Republican Senate, and House Democrats would bear responsibility for public outrage in light of the current government shutdown. The Economist Intelligence Unit, EIU, continues to track major business risks in light of volatile stock markets, elections, and geopolitics. EIU monitors geopolitical uncertainty and market and credit risks in 180 countries. At the global level, EIU describes several persistent business risks. These risks include the Sino-US trade war, oil supply contraction, and macro-financial contagion from Turkey and Argentina. As the Sino-US trade talks take place at the Deputy Secretary level, stock market indices from Dow Jones to Nasdaq and S&P 500 show hefty gains 3% to 5% in early January 2019. Stock market investors hope these deputy dialogues to reach some form of compromise for better Sino-US trade war resolution. Also, oil prices are likely to surge when OPEC countries cut their current oil supply. This oil price hike can cause inflationary concerns in most OECD countries. Several emerging economies may suffer near-term stock market gyrations due to oil supply contraction and financial contagion from Turkey and Argentina. The latest EIU report sheds fresh light on the biggest business risks as of early January 2019, Trump economic sanctions on Iran, social unrest in Nicaragua, and corruption and tax policy uncertainty in Lithuania. In contrast, Nepal and Egypt receive lower risk scores due to political stability, macroeconomic momentum, and gradual currency devaluation. The recent Bristol-Myers Squibb acquisition of American Celgene is the $90 billion biggest biotech deal in history. The resultant biopharma Goliath would become an oncology powerhouse with $8 billion blockbuster medications. Celgene share price surges 21% as Bristol-Myers Squibb, BMS, announces this acquisition. When the deal closes, Celgene shareholders would receive one BMS share, $50 in cash for each Celgene share, and one tradable contingent value right for each share of Celgene. This contingent value right entitles its holder to receive a one-time potential payment of $9 in cash upon FDA approval of all three key medications of ozanimod, December 31, 2020, Lysocell, December 31, 2020, and BB2121, March 31, 2021. BMS already owns a rich portfolio of blockbuster medications. These medications include the top-selling PD-1 checkpoint inhibitor Opdivo, the leukemia drug Spreecel, the melanoma drug Yervoy, the multiple myeloma drugs Revlimid and Pomalyst, and the pancreatic cancer medicine Abraxane. These medications generate about $5.9 billion revenue in 2018 Q3. These landmark medications position BMS as the market share leader in immuno-oncology and hematology. The BMS specialty market niche and patent portfolio collectively create competitive moats for the new biopharma Goliath in comparison to Johnson & Johnson, Merck, Pfizer, Roche, and Novartis etc. Apple revises down its global revenue estimate to $83–85 billion due to subpar smartphone sales in China. Apple CEO Tim Cook points out the fact that he cannot blame external factors for selling fewer iPhones during the holiday quarter. However, Apple fails to acknowledge the real possibility that the current iPhone prices may be too high. Apple iPhone prices are about 5 times higher than the average non-iOS smartphones sold by Huawei, Oppo, and Vivo. The high-end smartphone market may be fully mature with longer replacement cycles. This tech trend poses a major long-term challenge to Apple. There are at least 3 solutions to weaker global demand for Apple iPhones. First, Apple can broaden the scope of short-term programs for renting pricey iPhones. These rental programs can help transform high-end Apple iPhones into more affordable options. Second, Apple can consider introducing new media services in addition to Apple Music. Apple can apply the profitable business models of iTunes and App Store to real-time video streams, games, and other entertainment outlets. Third, Apple can take advantage of offshore cash repatriation to fund new acquisitions of media service providers. These solutions accord with the prior Apple business goal of growing media services to quadruple their sales and profits. President Trump forces the Federal Reserve to normalize the current interest rate hike to signal its own independence from the White House. There are at least 3 root causes of the current neutral interest rate hike. First, the real interest rate is remarkably low around the zero lower bound when the CPI inflation rate is about 2.2% and the U.S. federal funds rate lands in the target range of 2% to 2.25%. This near-zero real interest rate can cause serious problems. For instance, firms respond to the low cost of capital by taking on excessive private debt. Banks reach for higher yields by lending to high-risk borrowers with some deterioration in credit standards. Institutional investors can lever up to boost stock market prices to unsustainably high levels. The government tends to run fiscal deficits because the debt servicing cost is relatively low. These credit supply changes can sow the seeds of the next economic recession. Second, the Federal Open Market Committee, FOMC, can normalize the current interest rate hike such that the U.S. central bank gains greater instrumental bandwidth to deal with the next financial downturn. At subsequent stages of the real business cycle, the FOMC can apply gradual downward interest rate adjustments as the neutral interest rate allows the U.S. economy to operate near full employment with inflation containment. The current U.S. unemployment is 3.7%. And the FOMC expects the long-term sustainable unemployment rate to be about 4.4%. In the rosy picture of 3% to 3.5% real GDP economic growth, the FOMC has to gradually introduce interest rate increases to prevent 2.2% CPI inflation from becoming a major economic disturbance. In light of one rate increase per quarter throughout 2018, the FOMC expects to raise the interest rate twice in 2019. Third, the Federal Reserve now needs to normalize the current interest rate hike to signal its own independence from the White House. International evidence shows that monetary policy independence helps better curb inflation with steady gains in real GDP growth, productivity, capital investment, and domestic employment. Fed Chair Jerome Powell needs to continue interest rate increases to achieve a reasonable new Keynesian trade-off between inflation and unemployment, although he receives several criticisms from President Trump in recent times. Overall, the Federal Reserve has to maintain the current hawkish monetary policy pace in response to several economic headwinds from Trump tax cuts and tariffs to higher public expenditures and healthcare costs. Neoliberal public choice continues to spin national taxation and several other forms of government intervention. The post-crisis consensus focuses on government intervention as the root cause of socio-economic malaise in several OECD countries. Ideology continues to inform public policy, and neoliberalism specifically advocates a minimal role for the state in economic affairs such as taxation, healthcare, infrastructure, and immigration. Neoliberal public choice emphasizes regulatory failures rather than historical country-specific experiences. The sheer predominance of utilitarian myopia reflects fundamental misconceptions about the proper economic role of government. Contrary to the post-crisis consensus, active strategic public sector investment is critical to both economic revival and financial stability. The state should act as an investor of first resort, rather than a lender of last resort, for great technological advances and revolutions in finance, energy, transport, medicine, and information communication. The government can indeed learn much from the best business minds of Warren Buffett and George Soros in finance, Elon Musk in energy and autonomous transport, Peter Diamandis and James Brewer in medicine and health care, and Steve Jobs, Tim Cook, Bill Gates, Larry Page, and Jeff Bezos in information communication technology. Effective capitalism calls for facilitative state involvement in economic governance and regulation. President Trump issues an executive order to freeze federal employee pay in early 2019. U.S. federal employees face furlough or work without pay due to the partial government shutdown. President Trump further pours salt into the wound by signing an executive order that freezes federal pay for about 2 million public employees in early 2019. In effect, this executive order cancels the 2.1% pay increase for 2 million non-military federal workers, whereas, the same order cannot affect the 2.6% pay increase for military servants and soldiers. This strategic move expands the prior Trump claim that he would be proud to shut down the government for better border security. Specifically, President Trump demands $5 billion public finance for the southern border wall. The wall can improve the domestic quality of health care, education, and other public services for U.S. residents. The $5 billion border wall tax thus becomes essential for overall domestic welfare in America. On the other side of the same story, however, this executive order serves as a key Trump tactic that tilts Congress toward political compromise. The negotiation contributes to the Trump presidential campaign promise of better border security, although most Americans blame President Trump for the recent government shutdown. Reuters polls show that most Americans blame President Trump for the recent U.S. government shutdown. President Trump remains adamant about having to shut down the U.S. government in order to acquire at least $5 billion public finance for the southern border wall. This border wall tax helps fulfill one of his presidential campaign promises on U.S. immigration, which has long been a major source of diverse vitality for the American dream. The Trump intransigence is illustrative of his broader political philosophy, which often hinges on performing for the Republican base, rather than gauging the popular mood of the whole country. The rapid rise of President Donald Trump has been the natural result of his inclination toward political tribalism. This tribalism often leads Trump to design policies in a consistent way that places his political prospects squarely on the fervent loyalty of fellow Republicans. After losing House majority control to Democrats in the November 2018 midterm elections, President Trump entrenches himself and mocks the moderate Republican losers instead of expressing contrition or pledging to collaborate with Democrats. The same strategy works wonders for President Trump, as 75% of Republicans favor building the border wall despite declining approval in the general polls. Chinese President Xi calls President Trump to reach Sino-US trade war resolution. Xi sends a congratulatory message to mark 40 years since the progressive normalization of diplomatic relations between China and America. Cooperation is the best choice for both sides in light of bilateral trade history. As Xi politely urges the Trump administration to compromise on the current bilateral trade standoff, Xi attempts to avert the unilateral U.S. imposition of hefty tariffs on Chinese goods. This reconciliatory gesture serves as a mild response to the prior Trump trade battle plan of raising 10% to 25% tariffs on $200+ million Chinese goods. Trump tariffs harm the Chinese economy because the Shanghai and Shenzhen composite stock market indices plunged double digits with subpar 6.5% real GDP economic growth in 2018. During the current 90-day trade truce, both teams hope to reach an eventual trade agreement that would benefit both countries as early as possible. The presidents expressed their goodwill to implement Sino-US trade concessions made on the G20 summit sidelines in 2018 Q4. As U.S. Trade Rep Robert Lighthizer characterizes the risks of allowing China to join the World Trade Organization, trade alone cannot douse the flames of international rivalry, whereas, economic prosperity often contributes to bilateral conflict. American parents worry about money and upward mobility for their children. A recent New York Times survey suggests that nowadays American parents spend more time, effort, and money raising their kids. Merrill Lynch reports that the average cost of raising a child to 18 years old tops $230,000. The same report also suggests that 79% of American parents continue to provide financial support to their adult children. Costs for food, school, transportation, technology, entertainment, and other activities typically increase as children grow older. Also, 69% of parents admit to feeling pressure and even anxiety to give their children what their peers have. There is a key element of competition, peer pressure, or keeping up with the Joneses that entices parents to spend more money on their children. Economic prosperity motivates these parents to help ensure that their children are financially better off than the previous generations. A recent empirical study by the Federal Reserve Bank of St. Louis demonstrates that millennials face unique financial struggles. These financial struggles include higher unemployment rates, stagnant wages, less affordable residential properties, and student debt imbalances. Millennials are now at risk of becoming a lost generation that collectively accumulates less wealth during their lifetime. New York Fed CEO John Williams listens to sharp share price declines as part of the data-dependent interest rate policy. The Federal Reserve can respond to stock market plunges, but most FOMC members still view the U.S. economy as sufficiently strong to grow with higher interest rates. Williams emphasizes softening the central bank language that the next two semi-annual rate hikes are only economic projections. The upward rate trajectory is not a matter of right or wrong with Wall Street, and the central bank cannot be on autopilot at this stage of the current macro business cycle. Williams expects U.S. GDP to slow to 2% to 2.5% in 2019, from 3% to 3.5% in 2018, whereas, inflation should be around 2% in 2019. Trump tariffs continue to pose a major tone of economic policy uncertainty. Treasury Secretary Steven Mnuchin assuages bank CEOs and stock market investors that the Trump administration has no power to oust Fed Chair Jay Powell for his recent interest rate hike. Mnuchin consults the Federal Reserve and Securities and Exchange Commission on the recent partial government shutdown and stock market turmoil. This stock market plunge protection team receives reassurance from banks that there is ample liquidity for lending to both consumers and firms. American allies assist AT&T and Verizon in implementing 5G telecommunication technology in the U.S. as these allies ban the use of Huawei 5G tech equipment. This assistance arises as an equilibrium outcome several weeks after the arrest of Huawei CFO in Canada amid a U.S. probe into whether the Chinese tech titan violates U.S. economic sanctions on Iran. The U.S. federal government undertakes multiple measures to curb the influence of Huawei and its fellow Chinese telecom firm ZTE. These measures ban the Huawei and ZTE sales of 5G mobile devices on military bases. During the current 90-day trade truce with China, the Trump administration remains adamant about maintaining U.S. dominance in 5G telecommunication, which is at least 10 times faster than the 4G telecom standard. National Economic Council Chief Economic Advisor Larry Kudlow emphasizes the fact that 5G telecommunication technology is the top priority for national economic security. These landmark events echo the recent Trump bans on the cross-border merger between Qualcomm and Broadcom, as well as Chinese acquisitions of critical technologies in Silicon Valley. Apple and Samsung may or may not introduce their 5G flagship smartphones and tablets until 5G telecom proliferation reaches a critical mass before mid-2020.